Let me be brutally honest with you for a moment, because your financial future could depend on what I'm about to say. If you are an American investor holding Iraqi Dinar, what you don't know about a recent and very quiet announcement from the U.S. Treasury Department is actively positioning you in the crosshairs of the IRS for an audit, massive penalties, and financial ruin that could make any potential dinar revaluation profit completely worthless. This is not the usual hype or fear-mongering you see in dinar groups. This is a fundamental shift in how the United States government is viewing and planning to treat foreign currency transactions, specifically targeting what they deem volatile and speculative assets, and the Iraqi dinar is sitting squarely at the top of their list. The announcement, buried in the Federal Register and couched in dense bureaucratic language, outlines a new interagency initiative between the Treasury's Financial Crimes Enforcement Network, or FinCEN, and the Internal Revenue Service to aggressively pursue what they are calling willful blindness in foreign asset reporting. For years, many dinar investors have operated under a vague assumption that they would only have to deal with tax implications after a revaluation event, but that era is over. The new guidance effectively states that the mere act of holding a significant amount of a foreign currency, especially one with a history of promotion in speculative investment circles, now raises a red flag for potential structuring, money laundering, or tax evasion, triggering a mandatory review of your past and present financial activity. This means that before you ever see a single dollar of profit from your dinar investment, you could be facing a life-altering IRS examination. The key phrase they are using is pattern analysis, where they will be looking at the sources of your funds used to purchase the dinar, the channels through which you purchased it, and most critically, whether you have been accurately reporting the very existence of this asset on your annual tax returns. Many investors mistakenly believe that because the dinar hasn't revalued, it's a dormant, non-reportable asset. That's a catastrophic misunderstanding. The failure to report foreign currency holdings on forms like the FinCEN 114, the FBAR, and potentially the IRS Form 8938 Statement of Specified Foreign Financial Assets can result in penalties that are not a percentage of the asset's value, but a percentage of the maximum possible value they assign to it, which in a speculative scenario could be financially apocalyptic. We are talking about penalties that can easily exceed 100% of the value they determine, effectively wiping you out. The Treasury's announcement signals a move from a reactive posture to a proactive hunting strategy, leveraging artificial intelligence and international banking data sharing agreements to identify U.S. persons who have made transactions with known currency dealers. They are no longer waiting for you to file. They are building cases based on the digital paper trail you left when you bought your dinars. Think about that for a second. The information from your bank wire or credit card transaction to a dealer is already in a database that is now being actively cross-referenced with IRS records to find discrepancies. If you purchased $10,000 worth of dinar and did not report holding that foreign asset, you are already technically in violation. And under this new directive, that violation is now considered a high priority item. This is the shocking reality that the gurus and pump-up artists aren't telling you. They're still talking about hotel reservations in Baghdad while the U.S. government is building a digital cage around your investment. This is a call to action you cannot ignore. In the next segment, I will break down the specific forms you are likely missing and the exact step-by-step strategy you need to start implementing right now to get into compliance before you receive that dreaded certified letter from the IRS. Do not click away. What you learn in the next few minutes could be the difference between financial freedom and financial disaster. So, let's get into the grim specifics of how this Treasury announcement turns your dinar holdings from a speculative dream into a tangible audit risk, and more importantly, what you can actually do about it right now. The heart of this new enforcement strategy revolves around two critical forms that most dinar investors have either never heard of or have mistakenly believed do not apply to them. The FBAR Form 8938, the FBAR, Foreign Bank and Financial Accounts Report, is not an IRS form. It's filed directly with the Treasury's FinCEN network. And it requires you to report any foreign financial accounts where the aggregate value exceeded a $10 audit at any point during the calendar year. Now, you might think it's just currency in a safe, not a bank account, but that is a dangerous and incorrect assumption. The regulations are crystal clear. The term financial account is broadly defined to include not just bank accounts, but other types of financial relationships, including accounts that hold other financial instruments. The legal interpretation, backed by court cases, strongly indicates that a custodial relationship with a foreign currency dealer, where your dinar purchase is held in their vault or on their books on your behalf before shipment, or even the physical currency notes themselves categorized as a financial instrument can trigger the FBAR filing requirement. The moment the total value of your foreign-based assets and those dinars printed by the Central Bank of Iraq, our foreign asset crosses the $10 threshold, you are legally obligated to file. Failure to do so can result in willful penalties of up to the greater of $100,000 or 50% of the account's value, and these are penalties per violation per year. Now, layer on top of that the IRS's own Form 8938, which has similar but not identical requirements, often catching taxpayers who think filing one satisfies the other. The key difference is that Form 8938 has higher reporting thresholds, but is filed with your annual tax return, making it directly visible to the revenue agent who might be examining your file. The new Treasury Directive is fundamentally about data matching. They are now actively comparing the information they receive from international banks and payment processors about your transactions with currency dealers against the FBAR and Form 8938 databases. If your name shows a wire transfer to a dealer in, say, Hong Kong or Jordan for $15,000, but your tax return shows no Form 8938 and FinCEN has no FBAR from you, that is a direct hit, an automatic flag for an examination. This is no longer about a human agent stumbling upon your file. This is about algorithms creating a list of non-compliant taxpayers for the IRS to pursue. And the scariest part, the statute of limitations for failing to file these forms never expires if you never filed them. They can come after you 10, 20 years from now, after a potential revaluation, and assess penalties based on the value at that time. Imagine your $1 million dinar dream being wiped out by a $1 million penalty because you didn't file a simple form. This is the precise nightmare scenario the new policy creates. But there is a path forward, and it requires immediate and deliberate action. You must conduct a thorough review of every single dinar purchase you have ever made, determine the peak aggregate value you held each year. And if you cross that 10,000 threshold, you need to get into a compliance program immediately. The IRS's voluntary disclosure program is designed for exactly this situation, to bring non-willful taxpayers back into the fold before they come after you. The process is complex and requires precision, but it is your only shield against financial catastrophe. Do not wait. Do not pretend this will blow over. Your next step is absolutely critical. Stay with me because in the final segment, I will lay out the exact 3-step process you must follow to navigate this compliance nightmare and protect yourself. You have to be ready to take action today. Now we arrive at the most critical part of this entire discussion, the actionable, step-by-step plan you must implement immediately to shield yourself from the devastating consequences we've outlined. This is not legal advice, but a clear roadmap of the processes you must discuss with a qualified tax professional, specifically one experienced in international tax law and FBAR compliance, because generic accountants often lack the nuanced understanding required for this specific and high-stakes situation. Your first and most non-negotiable step is to perform a comprehensive financial archaeology to gather every single piece of evidence related to your Iraqi dinar investments. This means digging out every receipt, every bank statement showing a wire transfer or credit card payment to a currency dealer, every email confirmation, and any shipping documentation. You need to create a chronological ledger detailing the date of each purchase, the amount in US dollars spent, the exchange rate used at the time of purchase, and the corresponding amount of Iraqi dinar you acquired. This is not just for your own records. This documented timeline is the foundational evidence you will need for any compliance procedure and is your first line of defense in demonstrating to the IRS that you are acting in good faith to correct past errors. This ledger will allow you to determine for each tax year the maximum value of your foreign holdings to see if you crossed the $10,000 in reporting threshold. Once you have this data assembled, your second step is to immediately engage that qualified tax attorney or enrolled agent to evaluate your specific situation and determine the safest path into compliance, which will almost certainly involve one of the IRS's voluntary disclosure programs. For many who have unknowingly failed to file FBARs, the streamlined domestic offshore procedures may be the appropriate avenue, provided you can certify that your past non-compliance was non-willful, meaning it was a result of negligence, inadvertence, or a mistaken belief that you did not have to file, not a deliberate act to evade tax. This program allows you to file the last 6 years of delinquent FBARs and amend 3 years of tax returns to include Form A938, and crucially, it comes with a guarantee of no failure to file penalties. This is your golden opportunity to wipe the slate clean. However, if the IRS has already contacted you or if your situation has elements that could be construed as willful, the path becomes far more complex and requires a different, more rigorous strategy, which is why professional guidance is not a suggestion but an absolute necessity. Your third and ongoing step is complete and meticulous future compliance. From this day forward, You must treat your Iraqi dinar holdings with the same seriousness as any other foreign financial asset. This means accurately tracking their value and filing the FBAR annually if the aggregate value of all your foreign accounts and specified assets exceeds the threshold, and including Form A93D8 with your tax return if applicable. This new discipline is your permanent shield. It transforms you from a target into a compliant taxpayer, effectively neutralizing the threat posed by the Treasury's new data matching algorithms. The dream of a dinar revaluation should not be a prelude to an IRS nightmare. It should be a financial event you are prepared to manage successfully and legally. The information I have given you today is the wake-up call you needed, but this is where your responsibility begins. You now possess the knowledge of the threat and the blueprint for protection. The single most important thing you can do right now is to take this information, pause this video, and commit to taking that first step. Gather those documents. Start making those calls to find the right professional. Your financial future is too precious to be lost to procrastination or fear. This is your moment to choose a different outcome. Seize it.